Hello and welcome to this market neutral webinar from Fidelity. We're now almost 6 months into the post-Liberation Day bull market. Equities, especially in the US, are at all-time highs. Credit spreads are tight and bonds and stocks have all been moving in the same direction. But with signs of fragility now beginning to appear, investors are asking themselves, what happens next? How can I be more diversified, whether this be by asset class, by moving beyond the US into global markets, or in terms of reducing overall risk? Today I'm joined by Matt Jones, Ravin Srinivasan and Angela Choi. We represent Fidelity's market neutral strategies across equities, fixed income and multi-asset. Together, we'll be exploring how these strategies can offer investors diversification benefits. But before we start, please do use the Q&A functionality to pose questions to our panel, which we'll come to in the second part of this webinar. And welcome. Good morning. Let's start by Angela. Angela, let's address the most pertinent question. What is it that we mean by absolute return strategies?
So absolute return strategies aim to deliver a cash plus return, which means that they're not typically benchmarked to broader equity or bond market indices. But what that does mean is that regardless of rising or falling markets, we expect these strategies to deliver a return that is above the cash rate. How do we do this? This can be done in two ways. Either from the top down, which relies on global macro insights, or alternatively from a bottom-up approach, which focuses on using credit and bond and equity selection to choose the best names for inclusion within the portfolio. And what we do find is that when the portfolio is risk managed in a more holistic way, investors will be able to benefit from being able to diversify their returns across the portfolio, as well as being able to receive a more uncorrelated source of returns, uncorrelated with the rest of the portfolio across either their asset classes or across other markets that they're invested in.
So turning our attention to more individual asset classes, this need for diversification can be met through equity investing. Matt, what do we offer in this space?
Yeah, at Fidelity, and what I'm representing today and we offer in the equity space is what's known as our Absolute Return Global Equity Fund. But I think more importantly to understand is the Absolute Return Global Equity Market Neutral Fund, and we'll discuss what I mean by that in a second. Now, there's two important parts to an investment process, clearly. There's the alpha and then the portfolio construction. And when we speak about the alpha, and the alpha that we get from Fidelity that we're using in this process, it comes from our fundamental research team. We have about 125 analysts globally doing that deep bottom-up fundamental research. We have that history and we have that provenance of back to 1969 in doing this. And when an analyst does the deep fundamental research, they primarily come up with a research note and a rating on that stock, quite simply a buy or a sell rating. In this fund, and my job as a portfolio manager on the Absolute Return Equity Fund, is to essentially go long our highest conviction ideas in the buy ratings and short the highest conviction sell ratings. What you find over time is our buy ratings typically outperform their regional markets and our sell ratings underperform their regional markets. And my job is to capture the spread between those two widening lines, essentially the two alpha lines that are generated from our research team. Now, it's not just about alpha, clearly, it's all about portfolio construction. So we have a strong, very, very strong process and a very strong focus on portfolio construction. And this is where the market neutral thing comes in. What we aim to do is deliver a highly stock-specific portfolio. And what does that mean? What that means is we don't take any other bets in this fund. It's beta zero to MSCI or country world. So we'll perform in rising and or falling markets. We have no big style exposures, so we don't have value or growth exposures. If rates rise or rates fall, you see value growth rotations, that won't affect this fund. And more importantly, what a lot of investors are worried about currently is, the mega cap names, that concentration risk in a few names following a benchmark. Well, we don't have that. We don't have any size exposures. So we're eliminating all of these other risks to focus purely on what Fidelity does best, which is that deep, deep blue section you might see on your screens, focusing on highly stock-specific risk where all of the alpha and all of the volatility of this fund is driven by what we do best. Now, in theory, it's quite simple. If you have an idiosyncratic unique alpha source that we have, you can't get anywhere else. You package it in a highly stock-specific way where all of your risk is focused on stock picking, then you generate returns that navigate all markets, beta zero to MSCI All Country World, and a great diversifier for any investor and in any range.
I guess congratulations on what will be a 5-year track record this month. Whilst the portfolio has shown consistency of returns, can you tell us a little bit more about periods when this fund may not perform as well?
Yeah, definitely. I mean, I'd like to say everything works all the time, but quite obviously it doesn't. And it should be quite obvious where something like this doesn't work. I mean, we're a bottom-up fundamental stock picking house. That's the alpha source that I'm tapping into. So then what you would expect is, when does it not work as well? When the markets are not being driven by bottom-up fundamental stock picking. You know, when price discovery is driven by more retail investors, there's top-down macro shocks, things like, and you've seen in the last 5 years in the early period of this fund and more recently, you know, you've had Trump, you've had trade wars, you've had tariffs, you've had big movements in interest rates and inflation. You know, one or all of these things working at the same time will have an impact on the alpha, and that's where you tend to see it typically be a little bit softer. But the fund itself is specifically designed to navigate all markets, but it'll be quite a little bit softer in those periods where there isn't that deep focus on fundamentals and stock picking.
Thank you, Matt. Turning to Ravin, how does this approach work in fixed income?
Sure, thank you, Stacey. So with our absolute return fixed income fund, as Angela alluded to a little bit earlier, one of our key objectives is to deliver a product that exhibits a low level of correlation to the traditional set of asset classes: bonds, equities, and credit, and that's over the cycle. How do we go about doing this? We have this twin engine approach that's embedded within our management style, our fund philosophy. And we believe that combination really smooths out the volatility of the fund and is quite complementary, and in the end delivers higher, better risk return, adjusted risk return to our investors in the long run. So thinking a little bit more about this twin engine, the first one, which is the macro engine, has very much a top-down investment process with a focus on directional strategies. So here our goal is to figure out where we are in the economic cycle currently, and more importantly, where we're heading to next, globally and across regional blocks. Then it's a question of finding out how is it that our views are currently being priced in by markets. Because ultimately, what we want to do is reflect our convictions in products, markets, and asset classes where these are least priced in. By doing so, we maximize the potential gain to the fund if we are right, and we also simultaneously look after making sure that the downside, the potential drawdown, is limited if we are wrong. If we turn to the graphic on our right on the screen, it should be quite clear what we're trying to achieve in this fund in terms of a time horizon that we believe on which the macro themes would play out. So here, the orange line represents some kind of signal to ratio metric that tells us whether that particular theme is working out. And the x-axis represents the time scale upon which we expect the theme to play out. So it should be quite evident that if one was able to forecast an economic development, let's say a recession, well in advance, let's call it 2 years in advance, that particular view should come with quite a high payoff. But we should be clear that that's not what we're trying to do. And the reason, again, on this graphic is that at that stage, the signal-to-noise ratio is really quite weak, which makes this type of forecasting exercise extremely tricky. So I'd like to call zone A the prophet zone, and we tend to shy away from that. While where we want to operate is squarely in that B zone, where we can reliably identify opportunities that we believe will play out over the next 6 to 9 months with a payoff of 3 to 6 times what we're really willing to risk compared to the payoff. We also try to shy away from zone C because at that stage, the theme is almost completely priced in by the market, and that would go against that asymmetry principle that I laid out before. To finish up on the macro side, we have 4 main sources of alpha. So we have a rates market, G10 developed markets, as well as some of our more liquid EM local markets, inflation, currencies, and the credit indices. Now turning our attention to the second engine, which is this bottom-up approach, and has a much more focus on relative value strategies. So here, in a sense, this is where we put on our bonds geek cap hat and we try to figure out relative value opportunities that look interesting on the swap curve in inflation space, both in the cash market and the derivatives market. So this dislocation happened for a number of reasons. Could be short-term supply-demand dynamics, could be flows from non-economic agents, and we stand ready to take advantage of these opportunities. The point that I want to stress on this part of the portfolio is the main characteristic of trades in that part of the portfolio tend to be that they are non-directional in nature, so market neutral, but also that they have a low correlation with the macro themes in the rest of the portfolio. So framed this way, the bottom-up engine delivers a second stream of alpha that helps us smooth out the volatility of the fund and deliver better risk-adjusted returns.
I guess a follow-up question to that really is kind of what have you been doing with the fund this year to date? Yeah,
it's been a very interesting past 8 months since I took over the fund. Let me start by saying, first of all, the market environment has been highly conducive to macro investing, which has undoubtedly benefited the fund's performance. But we have been able to capitalize on the weakening trend in the US dollar, quite from an early stage, because it was our belief that the policies of the new administration was going to engender, as we've seen, this fiscal stimulus from the rest of the world, and hence lead to higher growth expectation outside of the US compared to in the US. And that was at a time when the market was still had as one of its narrative US exceptionalism. So I think that really ties in the message that I had earlier in terms of figuring out what the market is pricing in and where we see asymmetry in pricing. So we've been short the US dollar against a bunch of DM and EM currencies, rotating from a set of more pro-cyclical ones like the Swedish krona, the Australian dollar, Brazilian real, and Mexican peso, towards a set of more defensive ones like the euro, the yen, and the Swiss franc. In rate space, the main contribution to the fund has been our overweight stance on duration over the second quarter of this year. And that was expressed in a few markets in the US, in Norway, and a couple of emerging markets. And it was really on the back of our anticipation that this sugar rush of front-loading in the inventory cycle, in the export cycle to the US, was going to abate and economic activity will suffer a dip on the back of it. And that's largely played out. Against that, we've been underweight duration in Japan, thinking, and somehow to some extent, we still believe that the Bank of Japan is behind the curve, and there needs to be a higher risk premium in JGB market given the current fiscal stance.
Thank you. Next. Turning to Angela, it's great to have you here representing our Asia investor base. Are our investors in the Asia region facing the same types of challenges and the need for diversification?
So what we'll typically find for across Asia Pacific is that our investors there are still very, very much have a strong home bias to their markets. So what that means is that our Thai investors still prefer to invest in Thai markets, Korean investors prefer to invest in Korea, and so on. So what we typically find, though, is that these equity markets, especially in APAC and especially more emerging markets, are very, very volatile. So taking one on the screen, for example, if we look at the performance of the Korean equity markets that we've seen in recent years, you'll see that the fluctuations between the highs and lows are very, very deep. So there's a huge amount of volatility that we're seeing in these markets. In 1 year, for example, we can see a plus 47% return. And then the following calendar year, we see a minus 30% return. So that level of volatility is also very prevalent across all the other neighboring countries as well across the region. So there is a very strong correlation across the region in terms of the equity market performance. Now, in terms of what the global equity market neutral strategy can do for our APAC-based investors is actually look to solve this problem in 2 ways. So firstly, it removes the home bias by expanding the universe from a local equity market into that of a global one. And secondly, the neutrality of the portfolio in going long and short at the same time cancels out that market impact, leaving behind within the fund a source of alpha that is specific to stock picking that we can see within the fund. And that would actually help our investors by enabling them to diversify across markets as well as across other asset classes within their portfolios.
Thank you. And I guess, given that markets are at their all-time highs, what can we expect looking into the second half? Matt and Ravin, let's start with Matt.
Yeah, look, unfortunately for the last 5 years I've been saying the same thing, and it is just increased volatility, increased risk. There's significant downside obviously in equity markets and what's going on out there with the impact from tariffs still coming through. Obviously we've got the US and Trump continuing on the way he has been for the last kind of 6 to 12 months. We've got the impact of Israel and different wars, and that is actually really quite increasing volatility and make things a bit riskier, especially from an equity market point of view. Earnings still seem to be holding up, and we've got great stock dispersion out there, which is kind of underpinning a little bit of support for that kind of negativity around things. But again, this goes back to why an equity market neutral approach appeals, because it helps you reduce that volatility. We navigate that risk. But I think just generally going forward, I don't think it being, like you said earlier, it is fragile. It's a quite risky market out there with not too many green shoots, I think, on the horizon. But I'll leave the fixed income and interest rate predictions to my peers who are a bit more better versed at that than me.
I definitely agree on the question of there are still a lot of risk out there, particularly given what's priced in and the very high level of valuation today. From our stance in terms of the fixed income markets, we do still maintain that stance that we think the dollar will keep weakening over the next few quarters. We think maybe the pace will slow down, but really when we look at what's happening with hedge ratios in our client and investors' portfolios, when we think about recycling flows and diversification away from the US, we think that will be an underlying thread that should support a weaker dollar. Clearly, in terms of the economic developments, we have seen a much weaker labor market in the US. But again, coming back to what is being priced in rates market, today, currently, the market expects 25 basis point cut over the next 7 meetings from the Fed, taking us to the middle of next year. That does seem a little bit aggressive to us. Particularly, we think, while yes, the labor market has been weakening, there is still underlying strength, particularly on the consumer spending side, as we saw again with a very strong print on the retail sales economic release yesterday. So we think maybe the market's gone a little bit ahead of itself. On the other hand, there are other jurisdiction economies where there's barely any monetary policy loosening pricing, and two that comes to mind are in the UK and again in Norway, where we have less than a couple of cuts price over the next 12 months. So we are overweight this market compared to being underweight in the US, thinking that if we do have a recessionary outlook led by the US, it wouldn't be an isolated environment. And then finally, on inflation, we maintain our long in European inflation. There is an underlying market narrative that Europe will be flooded by cheap goods from China. That's not something we completely subscribe to, and in fact we think it's probably priced a little bit too much right now, and it is in deep contrast to the state of the labor market in Europe, which is still extremely tight compared to the pre-pandemic era.
Thank you all. So you should be able to see or have seen our standard range across all the asset classes soon on screen. You'll see equities, fixed income, but also our own multi-asset portfolio, which combines the best of our individual asset classes. And now we will open the floor to questions. Maybe continuing with Ravin. So what do you think about risk management and hedging within the fund?
Sure, that's a great question. I think it's fair to say that risk management is crucial within the context of our management style and our fund philosophy. And I don't want this to sound just as a throwaway line from a portfolio manager. I want to explain why we have this belief. And that really comes from our belief that market always presents opportunities. There's always an emerging theme. There's always a new development, all of which make for active investment opportunities. And I think if you really internalize that principle, then you realize very quickly that all you need to be successful in the long run is a robust risk management framework, which I believe is executed throughout our investment process. So as I mentioned a little bit earlier, in terms of our theme identification, we already put a lot of emphasis in terms of where we believe there's asymmetry in market pricing to make sure we maximize the gain in our funds and minimize the downside. During our trade structuring phase in the investment process, we always favor strategies, trades that exhibit lower volatility, has some limited downside that we can cap, and also have a lower level of correlation with the overall portfolio. And finally, at the implementation phase, we have a staggered approach to our risk deployment to make sure that we only reach our full allocations when we have high certainty that this theme is playing out. And on the more formal side, we adopt a system of stop losses that we religiously tend to within the themes. And then we also have a drawdown control mechanism via which the fund VaR limit gets reduced after a drawdown of 2 and 5% to make sure that we preserve our investors' capital.
Thank you. And turning to Matt, can you tell us a little bit more about your bottom-up stock picking research process?
Yeah, look, it's what Fidelity's been doing since 1969. So I guess it's that core fundamental research. The bottom-up stock picking is exactly what we tap into. So I don't specifically do anything myself. But when you think about the ALS team and what they do, they're looking at speaking to management. They're looking at their financials. They're speaking to the peers, doing the horizontal, vertical analysis. All of that kind of deep fundamental research that we all know and understand. Valuations. They're doing everything they possibly can just to come up with that essentially that buy versus sell rating, whether the stock's going to outperform or underperform its broader market. And it's exactly that deep fundamental research. It's quite simply what we're tapping into.
Thank you. Angela, more broadly, how is sentiment in Asia right now?
Yeah, I would say the sentiment across Asia Pacific tends to be more cautiously optimistic. Cautious in the sense that there is very low tolerance for underperformance, and there's very low tolerance as well for non-delivery of promises to the investor, to the end investor. So clients are willing to sort of vote with their feet if they feel that over a certain amount of time it's not delivering what their expectations are. And that's why having a really tight risk-managed and risk-controlled investment process is becoming increasingly important to them, because they do have that low tolerance for big drawdowns as well. But that being said, they are still very optimistic in the sense that there is still an element where they're expecting positive returns over discrete periods of time that they're assessing the performance. And that absolute return need is actually driving a lot more searches that we're seeing from our clients these days, just wanting to see a positive outcome, both in the absolute sense as well as in a relative sense.
Thank you. I guess that actually leads to one of the questions that we've just received live, directed to Matt. Where are we seeing the most client demand for our strategy, and how has it changed through time?
You know, it's an interesting question, and the thing I love about this fund the most is client demand is coming from everywhere, from kind of a retail wholesale level to institutionals to hedge fund of funds. It's actually quite diverse across the world. And going back to what we've been saying here today, why is that? Because it is uncorrelated alpha sources, it is uncorrelated portfolio construction. We're focusing our risk budget on things that will work in most situations and most portfolios. So again, like I think we originally had a lot of interest from Central Eastern Europe. It's largely spread across the world to most of Europe, including Asia and potentially Australia. I think more importantly too, it's the type of clients that we have, again, hedge fund of funds, multi-strat funds, hedge fund instos, the whole kind of works from multi-asset teams down. And it is a perfect fit for a diversifier across all kind of asset class, all people. That's the happiness in this product.
So I guess turning our attention to Ravin. Ravin, how does the Fidelity macro team help us drive alpha in the fund's top-down engine?
Sure. So obviously we have a lot of resources at Fidelity. You've heard Matt enumerate the number of analysts that we have. We have very similar labor force and active contribution within the fixed income department. We have a lot of credit analysts that do a lot of the bottom work. In terms of a macro, that is still helpful, particularly when you consider that the financial system is really the fuel in the economy. We do get a lot from that we take from our macro. We have a very dedicated team of economists led by Salman, and that is one very important data point within our framework of identifying where the economy is heading next. We use a lot of resources from our quant team, which do a lot of work in terms of market signals, in terms of cycle signals, in terms of seasonality, in terms of identifying the right carry-to-vol ratio trades. So we have many weekly meetings, and we try to gather as much information as possible and synthesize that within our priors and our investment process to try to make the right decisions.
Okay. In which case, I'm going to stay with you.
Sure.
A follow-up question from one of our viewers this morning. Do you have any thoughts on the upcoming UK budget?
Sure.
Are you positioned for any outcomes?
So I think it's fair to say that that's a topic that's top of mind, and I think it's almost inescapable if when you're living in this country. And we now have a date set. The budget will be presented on the 26th of November. That's some 12 weeks away. 12 weeks of trial balloons and media leaks that I'm not particularly looking forward to. But to come back to the subject, so we think the Chancellor will have to manage a consolidation effort of about 26 billion of pounds. That's a little less than 1% of GDP. The breakdown to how we get to this number comes from about 10 billion, 15 billion actually, is on the back of the recent rises in gilt yields, the walk back from the Labour government on welfare reforms and winter fuel allowance, and then 10 billion comes from the downgrade in forecasts from the OBR on productivity and GDP growth. How will the Chancellor deal with this? We believe that's almost a certainty now that we will see an extension of a tax threshold throughout the whole fiscal horizon. That should raise about 12 billion in revenues. And then you come to this plethora of smaller policies that each will generate between 2 to 4 billion. And we can expect something on the property side, whether that comes through via stamp tax duty reforms, county sale tax reform, national insurance on rental properties. All of that is in the mix. We also expect something on the pension side, but in terms of the tax threshold that pensioners will pay, and then finally something maybe on the banking levy. I think one important development in the last week has been this message coming out from number 10 and number 11, Downing Street, has been that they are being very careful that any revenue-raising measure will not have a higher inflationary impulse to the economy. And I think that is a correct message, because if you look at the story of the past 6 months in the UK, we've seen this reacceleration in the inflationary rate, really led by things such as the national wage increase, the national insurance increase, and also administered prices via water and sewage. So I think that's quite a comforting message. And where does that leave us in our portfolio? We currently have an overweight stance in gilts, mostly as I mentioned before, because we're not pricing a lot of rate cuts from the Bank of England, but also the net supply of gilts coming to the market decreases quite substantially over the next 6 months. And that's mostly on the back of the Bank of England anticipation and market anticipation, really, that the Bank of England will most likely stop their active sales at the current meeting this week.
Thank you. I guess turning our attention to an entirely different topic, AI, which is obviously very prevalent at the moment. Matt, do we use any sort of AI tools in our process? And then we'll sort of ask you, Raveen, something broadly similar.
Yeah, we definitely do. And we've been using AI essentially on our research notes in the process that I run for about 7 or more odd years. And it's used in a way to just increase efficiencies and make it easier for myself and my colleague, Hiten Savani, the co-portfolio manager, to find the best ideas at Fidelity. You have 2,500 active ratings out there on any one day. And we shrink that down to about 160 names in the portfolio, 80 long, 80 short. Now, I can't read 2,500 research notes. But what I want to do is make sure the stocks that I'm buying read like the best conviction, highest conviction ideas. And we use AI to read the research notes and help us narrow it down to a higher conviction universe of ones that actually really read like that kind of high conviction quality idea that we want in the fund. Obviously, once it's passed all our other kind of filters and screens. That's how we use AI in our process right now. But also the fundamental research team globally is adopting AI in very much a similar way. To feed that history, like I said, we've got research notes going back to 1969. We could pull up the IPO note for Apple. There's a lot of information there, and it's only Fidelity information. You can't get that outside. So we know with AI, it's all about the data. We have the data. We're going to start using that more within our research team to make our analysts even better at separating those names that outperform the market, those buy red names, and the sell names that underperform the market. I think the adoption of AI is similar to what many other kind of fundamental equity teams are doing in the world. I don't see it displacing the analyst. The human brain is probably the most efficient computer in the world still. We have some of those people sitting globally doing the stock picking. What it'll do is make them even better, increase their hit ratios, generate much stronger alpha across the breadth of our research team.
Sure, I totally agree with Matt. I think even as a fixed income portfolio manager, macro portfolio manager, we are flooded in with information coming from the sell side, coming from macro strategists, third-party advisors, mainstream media, or even social media sometimes. And as a result of which, you do need to filter out some of the noise and really try particularly to gather as much information that's pertinent to you. And that's really where AI helps us on a daily basis right now. In terms of maybe more of a quantitative measure, we do use some of the capabilities to perform more conditional analysis. I can give you an example, but if you think about how you would go about trying to figure out what are equity performance after 3, 6, 9 months after the first Fed rate cut, that is something that's very doable, except it's time consuming. Something like that, if you have all the data in a database, is really, really easy for an AI tool to carry out this type of analysis, and that really helps us.
Thank you. We've got a lot of audience participation this morning. I guess turning back to Matt, but are there any big sector bets in the fund at the moment?
No, but we deliberately tried to alleviate all of those on a net exposure basis. We want to be essentially equity market neutral. So there's no significant sector bets, but what we do see in the portfolio is some of the bottom-up influences in aggregate from the research team kind of driving the small kind of net positive or negative exposures. Generally, we're overweight IT, but that's definitely not hardware equipment. That's more like softwares and services. We're slightly underweight energy, with a slight positive tilt to financials. There are no significant bets there, especially in our portfolio, because we have that breadth. I think what is more interesting and pertinent that I've seen over the last kind of 12 months or more from the aggregate research team is, like I keep saying, we invest in the highest conviction ideas. We're benchmark unaware on a regional and sector basis. So we're just looking for where the alpha versus risk is best in the world. What I'm finding is our gross exposure in the US has come down. It was probably plus or minus 5 to 10% outside of where it would normally be. And that's slowly come and shifted to Europe, UK, and the rest of the world. And I think that's natural given increased risk in the US. Things are getting a bit extended and stretched, so you tend not to see as many higher conviction ideas. So from a regional point of view, I think it's a bit more interesting than what we're seeing from a bottom-up sector point of view at the moment.
Oh, thank you. And I guess that's a nice segue to you, Angela. When we think on a regional basis, are there any bright spots broadly in Asia at the moment?
Yes, certainly. So there is quite a lot of different markets moving in quite different directions. But on the whole, in general, everyone is very tech-focused, and there is a lot more movement towards sort of the AI space. So what we are seeing is that there are a lot more investors sort of more keenly interested in how AI is integrated into our investment process as well, similar to the questions that Raven and Matt was talking about. And we sort of are very responsive to that as part of our investment process, just to reflect the changing conditions and the changing nature of that. The second part in terms of, I guess, another bright spot for us is actually sort of what we can offer to investors in terms of stability and low volatility of returns. So what we are seeing is an increasing demand for absolute return strategies, but very volatility controlled as well. And we do believe that we have the product range and the right number of solutions to provide our clients that we are speaking to, and very open to those conversations in more detail in terms of how that might fit into their overall portfolio.
Thank you. And I guess continuing this theme of sort of sector and region, Ravin, what do you think about developed versus emerging markets in the fund?
It's a good question. So we have a cautiously optimistic stance on EM, and I think part of that is a question of valuation. You are seeing some historically very high level of real yields in emerging markets, particularly if you look at the LATAM markets such as Brazil, Mexico, Peru, where inflation, spot inflation that is, where inflation is currently running at, has really been depressed. And that's on the back of the current strength in their currencies versus the dollar, but also partly because of what I touched before. These emerging market economies do get affected from the importing Chinese disinflation. And we think that trend is likely to continue, which is why we are overweight in terms of duration in these particular local markets. Yeah.
And I guess a question actually for both of you from the audience, but how's currency risk managed in your funds?
Oh, you can answer that
You
first.
can continue,
I'll come back to you.
Sure. So with absolute return fixed income, our benchmark is the cash rate. And so all our levers in terms of duration risk, currency risk, inflation risk, and credit risk is at zero. So for us, any currency bet that we take is an active bet. So we tend to use a lot of forwards in FX to take this view, that then we roll as we see fit, and until we either the trade work out or we decide that it's not worth the risk anymore.
Yeah, and I guess it's very similar to us. Again, reinforcing that point, is an equity market neutral fund. We neutralize all kind of currency risks. So if we were 40-50% long US, we'd be 40 to 50% short US. So you actually have no real currency exposure at that kind of economic level. Same for Europe, same for kind of Australia, UK, rest of the world. So small nuances there. And then clearly everything will be hedged back to a US dollar class by our currency team. So there is no, we don't manage currency risk because there is none there effectively.
Goodness, everybody's very active this morning. Thank you for your questions. Keep them coming. Ravin, do you have a view on the fiscal picture overall in Europe?
Sure. So again, Europe is one of those places where I would characterize our stance as being cautiously optimistic. And I think that's clearly to the point of the question. There is more of a domestic effort in Europe, particularly driven by the fiscal package that's been voted by the German Bundestag at the beginning of summer. But I think maybe to take a step back and look at the European growth landscape over the past 25 years, we can identify three distinct regimes. There was this pre-2008 global financial crisis period where really European growth was a function of credit boom in the southern economies, Greece, Spain, Italy, and Portugal, on the back of the residential and property development sector. Germany at that time was only emerging as its status as the sick man of Europe. Then we have the period after the GFC where austerity really constrained these periphery economies, while Germany and the northern European economies re-established their credentials as export and manufacturing powerhouses. Then more recently, in fact, I would say the script have flipped again since the invasion of Ukraine by Russia, where Germany and the northern European economies have had a little bit of a malaise on the manufacturing side because they don't have access to one of the key resources, which is the cheap energy flow from Russia. And again, European growth has been a function of Italy, Spain, and Portugal, which had gone through their deleveraging process and are now at a much better in terms of exports, in terms of manufacturing renaissance. So today, our optimistic stance is really by the fact that for the first time this side of a century, we are likely to see a European growth landscape that is that's where both cylinders are firing, the northern countries and the southern countries. And we think that's not reflected in markets. We think both rates and inflation are underpricing that. So we are underweight rates in Europe, and we still maintain that long in European inflation on the back of how tight the labor market is. But I'll be quite interested to hear Matt's bottom-up view on European landscape.
Yeah, it's pretty much exactly what we're hearing from the fundamental research team out there. You know, the greater opportunities, a lot more growth. I think it's really underestimated that where the alpha and the value that's going to come from those regions because of exactly what you've been saying. It's pretty much spot on.
I guess on that, you know, we're often asked sort of how that features into the bottom-up process. You know, do we favour the European analysts in this type of environment or the US ones? How does that work, Matt, and feed through into the approach?
Yeah, well, essentially, I favour all of our analysts equally, and for all the obvious reasons. But what you do see, like I said earlier, is you do see shifts in growth and potential and ideas. I mean, the obvious one recently was the invasion of the Ukraine, defence spending. That was a structural long-term shift that we're seeing. So you start to see the analysts move into those structural long-term views. You know, steel names start to get higher conviction ideas, more growth prospects, more earnings prospects, valuations previously looked fine there. So what you do is you don't favour any analyst, but you see the alpha shifting around the world depending on the market environment.
Thank you. I think, generally speaking, it's great to have you with us and answer all the questions today. Thank you. I think that's all we have time for today. It's been great to talk about both the equity fund, the fixed income fund, but also a reminder that we also have Fidelity's absolute return multi-strategy fund as well, which combines the best of these. And thank you for dialing in. If you'd like more information about our market neutral strategies, please do reach out to your local Fidelity contact. Thank you so much for watching, and goodbye.